you're going to continue to hear about, the old school or old way of marketing, and that's looking and using the carry of the market. And that's what we're going to continue to talk about here today, using our corn market as an example. Keep in mind as we go forward through this webinar, everything we talk about is for education and example purposes. Make sure that you guys understand your own risk tolerance as you go through this. So like we mentioned, old market conditions, and what are we referring to there? That's capturing, carry, and managing basis. For the last 3 or 4 years, we've been more of an inverted market. Now we're starting to come back into that normal scenario where you start to get market carry, and we need to take advantage of that. One thing that you can consider looking at, and we're using the March 25 corn example here, would be selling covered calls. And really, you're going to have 3 outcomes in the market. If the market goes down, you get to keep your premium. Now, keep in mind, you aren't going to have a price floor. If the market is flat, which can be typical in a carry market, you get to keep your premium and you might not lose too much futures erosion. And if the market gets higher, you're going to continue to keep your premium and you're going to get a better price for your grain. Now, keep in mind, these are covered calls because you need to have the physical bushels to offset if that call goes higher against you, if you will, in your hedge account. So again, looking at March 25 corn, here's our example. You could sell a 450 call here today and collect about 15 cents. That equates to about $750 a contract, or if you're a 200 bushel farmer, that's about $30 an acre. Initial margin on this position is going to be $800 with the potential for other margin calls if the market goes higher. You can also reduce that potential for margin calls by putting in more than that initial margin. But let's go down to the expiration point here. So if March 25 corn at expiration is at 475, you're going to be sold on your 5,000 bushels for 465. That's at 450 strike price plus the 15 cents less any commissions and fees. If the market's at 425, you're still going to collect your 15 cents and you're still going to have control of your bushels. You didn't get called away. Now, if you were to sell on that day, your net board price would be about 440. If the market's at 4, you're still going to keep your 15 cents. You're still going to maintain control of your bushels because you didn't get called away. And if you did decide to sell on that day, you would have a net sale of 415. The other thing we have to keep in mind here, like we said, as we're going off of the March contract, is the two-pronged strategy to this approach. What kind of basis improvement could you get here as well, in addition to collecting some call premium? Like we mentioned, this is a marginal position, and then these don't include your commission and fees. Here it is on a chart. This is your daily March corn chart. 465 is where you would get called away, about 40 cents above the market. I think guys could live with that if you were to make that decision here today. What's a little more interesting is we go over to a daily front month contract, and as you can see, that orange line represents the first of the year. Well, since the first of the year, we've hardly spent any time above 465, but in fact, the front month high since the first of the year at 475 3/4. So in our viewpoint, this is a fairly good value, a reasonable thing to try and take advantage of. We can live if we get called away up near the highs of the front month contract. So wrapping everything up again, guys, like we said, capturing carry is going to be the theme of the market, whether you just sell futures or roll futures ahead, or you look at doing some kind of option strategy. You're going to need to look at picking up some basis improvement rather than moving at harvest. Look out to those carry months, or those storage months, if you will, Jan, Feb, March, April, May timeframes. And then, like we said, the whole point of this webinar is consider selling some calls to collect premium on bushels you have in storage. Challenge the market to come up and get your price and get paid to do so, or use it to offset puts. A lot of times you'll see sold calls when you're buying a put in a fence position scenario, which again is still marginable, but again, another good strategy to consider. If you have questions, feel free to reach out to us or leave a comment below. As always, we appreciate you hitting the like button. Be sure to subscribe, and we'll be back with another update here shortly.